All right. Transcorp PLC, that's Transnational Corporation Plc, hedge half year 2026 results. Revenue dropped, group revenue dropped by minus 13.4% to 241.5 billion. Profit after tax dropped by minus 16.6% to 54.4 billion. The headline marks a sharper story inside. So read along. Let's unmax it. So going forward, let's go. So let's look at the graphic. So this is first of all the graphics of Transcorp, PLC. So you can see what price the price toppled out at over 80 something naira. That's their price toppled out. Then for the downside, currently price is trading within the handle of 40 naira plus as at the time of recording. So you see the sharp increase and the decline. For guys that bought into here, for people that say they always, this was in 2024, for people say they always buy. So while you are buying value, misunderstanding the quote of timing the market time, they never knew that entry is most important. So you must have been waiting for even 2 years. You must be damn money over 50% for the past 2 years, just waiting, because you are blindly buying every week. I don't know how they learn to those things without knowing that there's always a time. Even if you're buying a great asset for whatever reason, there is a time to also buy. There is a valuation level to buy at, which always coincides with a technical level. You must not use technical charts, but there is always a valuation level to buy. So you must have been damn money for 2 years. So let's look at the income statement. And for the income statement side of things, let's blow it up. So this is the income statement. You see 26, you see how the revenue dropped. You see the gross, even cost of sales. Of course, maybe you are selling less. Remember their main products, power and the hospitality. So maybe probably because you are selling less too, generating less revenue, so the cost of making those sales will naturally go down. And we have covered the head Q1 2026 too. There was a decline too. So this is two conservative quarter decline. First quarter decline, second quarter decline. Then also, if you look at the operating profits, the same decline. We look at so that's where the margins across board dropped. The margin across board also dropped. So profits, even profits, so the three margins, they were all dropping. The only thing that improved is the coverage ratio. Coverage ratio. So we will tell you what led to the decline, which segment of the business is suffering and stuff like that. So we are coming to you, but just know that there is a decline across board. Low margin sales. That's why all the margins compared to last, overlay it with the other time in 25, all of them flashing decline. Then this is the balance sheet side of things. Of course, assets grew, but look at this line, pay attention to it. Where is that line of receivables? Trade receivable is ballooning. Trade receivable is ballooning over 17%. Then of course the equity side of the business. Then long-term borrowing. The borrowing was now required, and long-term borrowing is also growing. Like ballooning, this one is no longer glowing. It's ballooning over 20 and something percent. It was the short-term borrowing that was required. Then the equity, total equity side of things too. You look at the total equity side of things too, you see that it's also actually improved, which is very good. But then you look at the liability side of things. So this is the balance sheet. Then for the income statement, for the cash flow statement, you see that the cash flow statement, we also have a negative free cash flow again in 26. The only thing is it was lesser than that of the 25. So this is, it was now lesser in 25. So we have currently a negative free cash flow of 19.26 billion compared to what it was in 25, which was 33.62 billion. So that is it. So let's go and give you the details behind the numbers. If you are looking at the detail behind the number, first of all, your revenue drop. Which the business has four major, or there are four major segments. We have the power segment, which is the dominant. This is a conglomerate. Even that power segment is even listed as a different business as Transcorp Power, which we will still analyze, but it is the major segment in this conglomerate. The other segment is the hospitality side of it, and then the remaining two, which are still very minute, is the Transcorp Energy and Transcorp Agro Allied. So this remaining two is marginal. So in terms of performance, it is that Transcorp Power that is doing the dragging. So that Transcorp Power, the power arm of their business, is dragging the group revenue, and because it has a significant size, so it is dragging it. While hospitality is the only segment that grew revenue. The remaining three, yes, negative. And this is now back to back. The second thing to bear in mind in terms of geography, of course, they export some of their stuff. So both Nigerian, because they geographically categorize their revenue into Nigeria and outside Nigeria. So both arms dropped too. For the Nigerian side, it dropped by minus 14.6%, while for outside Nigeria, it dropped by 10%. So net double whammy. Nigeria, outside Nigeria, everything is dropping. Precisely the power. Then there is also some things to also note around it. You have to bear in mind that even some of the gains you were seeing, you did what we call impairment. They do an impairment right back. That's initially how it works is businesses make provision for impairment. When you start writing it back, it means there is no impairment. Even though you writing that at the backdrop of that big receivable, so their receivable is too much. You don't need to be told of what is happening in the power sector in Nigeria. This Genco, because this is a Genco, that's people that generate like that's what it's called. They are being owed legacy debt. Even the federal government at a time, it was coming in tune of within 4 to 6 trillion, and the federal government is sorting it out to see how they are being paid. So it's part of that receivable too. So the question now becomes, you have such receivables, why are you now writing back a payment? Is it just to improve books or what? The second thing is they had what you call deposit for shares, which is a quasi contingency obligation with unclear payment mechanism. Let me explain. They have close to 84.59 billion obligation to meet, and that obligation is among these 84.59, close to 82.19 billion of it is tied to the AFAM Genco acquisition financing. There's a power plant they acquired years back, which is in Rivers State, AFAM power plant. So stay hanging. That is the explanation we are making there. And finally, the receivables are ballooning up like we showed you. Now, receivable is currently sitting as 112.6 billion, And this also led to them having tax payables, outstanding tax to pay, which is seen around 91.96 billion. So this is the challenge. The major challenge is coming from that power sector, number one, and the receivables, which is also majority part of the power sector. So that is the playbook. That is the playbook about this. So going forward, that is why we said two variables resolve the H2 picture. Number one is whether the 112.6 billion receivable, which has been built to reverse through collection, and whether the H2 finance cost to carrying the full year weight of new debt for the first time will compress profits line further. So these are the answers we are searching for from this, to see how it all pans out. So see you in the next trade. Peace.